Let's do some Forex trading, huh? Let's go. Good morning, everybody. Boy, it's been a tough morning. Anyways, hey, let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small. Stay humble, focus on the long term, and never risk money you cannot afford to lose. Cool, Bucky. Make sure you help me put one together, huh? All right. Oh, hey, my name is Wayne. I'm the Chief FX Market Strategist for TradersWay.com. We got a big day today. Glad to be here. Thank you very much for being on our team. We got the Jackson Hole speech today, and it's a big opportunity for a misstep. It's pretty clear that not everyone is fully on board with the current monetary policy. And yet the markets have priced things in. So lots could happen. I think a lot of people could be disappointed today. So anyways, the markets are moving. Should be good. My name is Wayne McDonald. I'm the Chief FX Market Strategist for Traders Way. I've been trading for a very, very long time. I'm here to answer your questions and teach you some technical, maybe some fundamental analysis and get you through this thing called Forex Alive. So get involved, ask questions. So markets are moving in the sense that people have to jostle for position, but also to protect themselves. So if things are going down, doesn't mean people are selling. They might just be hedging. Or they might be getting out of positions. Meat for breakfast, nice. So always keep that in mind, okay? So like, this may be people selling, this may be people taking profit. You notice the logical entries and exits? It's another thing to point out. Is this total madness and chaos? Or is it predictable? Of course, if it's predictable, it's logical. And if it's logical, it ain't chaos, right? Where's my little drawing tool thing? Letters, oh, I see. So anyways, that's the target for the week. Now, the proper entry would have been down in here, but you can see that it used the monthly as the support, not the weekly. That makes sense? So this is very nice. I like to see things like this, and it reminds me that this is not a random walk. It reminds me that this is not chaos. And if it's not a random walk, if it's not chaos, and if it's fairly logical, then you can learn it and you can trade it. If it is completely random, there's no way you can learn it. So what's the point? If it's random, there's no point. Like you cannot learn the lottery. But you can learn how to trade. So I like to look at these things and say, you know what? People drove this up. They hit the weekly M4. And just hours before a big risk event, what happened? They took profit. They got out. What would be the smart, logical, intelligent thing to do right before a big risk event? Remove the risk. Look what's happening. Out of $5 trillion a day, how much of that is USD Swiss franc? I don't know, 800 billion? You know? I mean, it's a lot, right? So this is a big deal for this to happen. but I think it's a bigger deal to know that it would happen at a place we would have expected. Does the yield curve signal a possible recession? Well, that's what an inverted yield curve does, but I don't see it as important as it historically has, because it's been historically driven by the market, not by central banks. Does that make sense? So, like, why did the yield curve invert? Because the Fed told the market, we are going to buy bonds. And they're going to buy so many bonds. By bonds, I mean treasuries, but go with me. We are going to buy bonds, and so much so, we are going to force interest rates down, and then we're going to force it even farther down, and then we're going to force it even farther down than that. Yeah, Underjack, yeah. I need to redo it because the sound was pathetic. So, what does that tell you? They're going to buy bonds, they're going to buy more bonds, they're going to buy more bonds, and they're going to buy more bonds. And so much so, they're going to force the yield of the entire market down. So what happens to price? The price of the bond up. So when the government, if I can call the Fed the government, if the government tells you they are going to drive prices up, and they're going to continue driving prices up for the sort of the foreseeable future, what should you do? What should you do? Wow, we must have a big lag today. Well, what should you do? Yeah, something's not working. There's a lag today. And another over here where it typically shows viewers, it says 0 viewers. Unless there's 0 viewers. Maybe you're not answering because I'm all by myself. No. Oh, thank you, Adam. Anybody else want to take a guess? What would you do if you knew for a fact housing prices were going to go up 50%? What would you do if you knew for a fact gold would go up 50%? What should you do if you knew for a fact that you knew Apple prices were going to go up 25% in the next 2 months? What should you do if you knew this was factual, backed up by the government, the army, and Taylor Swift? You would buy it. Now, why would you buy it? Why? Because then you can sell it to somebody and make money, right? You would profit from it. So that's what's happened. The Fed said, we're going to buy so many bonds out of the existing market that we're going to drive prices up and up and up and up, and therefore yields down and down and down and down. Billions and billions and billions and billions and billions of dollars. And they're going to keep doing it. So what do you think institutional investors did? They're front-running the Fed. They buy the bonds so they can sell them to the Fed, or they buy the bonds because all bond prices are going up, guaranteed. all bond prices are going up guaranteed. And because of that, the yield curve inverted. Now, did it invert because bond investors are scared and frightened and they're exiting the stock market and hiding their money? Or did they do it because the Fed said, hey, dude, you want some free money? You guys, anyone that was hanging with me I guess more than 5 years ago, 6 or 7, 8 years ago, we had this thing called the free money rally. And we traded this day after day after day after day. Free money rally. The stock market went from 8,000 when I started screaming bloody murder to buy it. And now it's at 20-something thousand, right? And it was all based on free money from the Fed. And housing prices went, up. Around here, they went up 50% to 100%. Why? The Fed. Free money. Poor people stayed poor. You know this. You hear it in the statistics every single day. Poor people stayed poor. Rich people got richer. Why? Because rich people own assets. They don't own giant TVs. They don't spend their money on giant TVs. Poor people do that. They own assets, and then the assets go up in value, plus often provide income, depending on the asset. And then the Fed came in and said, we are going to have a monetary policy that is designed to increase asset prices. How many people heard that? Like you read it in a newspaper, you saw it on TV, but in contemporary life, like not even just CNBC, not just the Wall Street Journal, but you read it in your local paper, you read it in the regular paper, the regular average Joe. So right across from the sports page, right? You're reading the sports page and you glance over there and there's a little article about business on the opposite page and you read it and it's like, the monetary policy is increasing asset prices, right? So rich people got rich. Why? They own assets. And what happens when these assets that are producing income and the government is driving up the value of those assets? So now you went from, you had $1 million, now you have $2 million, and now you go buy your stupid giant TV, right? Other people, they put it on their credit card or they spend their salary on it. And that's what makes them poor. They don't buy assets, they buy garbage. Okay? But imagine this, guys. This is what's going on. So if bond prices go up, so we'll put bond prices in dollars, right? Then bond yields go down. And by that, I'll do percentage. So we have an inverted yield curve. A yield curve should look like this, but it looks more like this. Should I worry? Well, not if it's artificial per se. So what usually happens, guys, is the economy, and we'll talk about like GDP is falling. We'll say inflation is falling, right? Jobs are falling, right? So on and so forth. So then the Fed goes and does this monetary policy to change all these things. The funny thing is GDP is good. Inflation is good. Jobs is good. So should I worry about the inverted yield curve? Well, I want you to I want you to understand. So I didn't realize it was going to go into yield curve analysis. So let's talk about this today, if you don't mind. Yeah, okay. So how am I going to explain this? Okay. Let's use logic. Let's use business sense. Okay. We'll describe what a bad yield curve looks like. The one that does predict a recession instead of what we have now, because it's always to say, oh, it's complicated, or I don't want to say this time's different. You have to be careful of that. But let's talk about truly what a yield curve typically predicts and why. I want you to know, I don't want you to think inverted yield curve predicts a stock market crash. I want you to understand why, the mechanisms and humanity behind the statement, okay? So we'll talk about this, we'll talk about this as, okay, this is interest rates, and this is time. So we'll say 1 year, 5 year, 10 year, 20 year, 30 year treasuries, okay? So that's time, that's year, okay? And rates. So we'll go 1%, 2%, 3%, 4%, 5%. Okay? You got me? Or you following me? Okay. All right. So let us draw a let's say a nice yield curve. Okay, we'll use gray, and we'll say this. Ah, please, stupid software, don't do that. There we go. And I got to do it again. Come on, stupid software. All right, I'm sorry I called you stupid. Come on, software. All right, so here's a yield curve. Okay, and let me explain what it means. Let me explain this, Lucy. If you borrow money for 1 year, the risk is very low to the lender that you'll default, assuming they've done some basic due diligence. Do you have income, for example? If I lend you $10,000, what is your ability to pay me back? Now, and so I look and I see you have a job. What's the likelihood you're going to lose your job in the next year and default on me? Pretty low. What's the likelihood for you to lose your job in 5 years and default on me? I say, well, 5 years, that could happen. What is the likelihood over the course of 10 years you would lose your job and default on me? You're like, well, 10 years is a long time, and 20 years is even longer, and 30 years is even longer. So if you were a bank taking on this risk of default, you would say, well, if I lend you money on the short term, my risk isn't that high, so I'm going to charge you a low percentage. But as the duration increases from 1 year to 5 year to 10 year to a 30-year mortgage or whatever, the risk that something will change during that time period goes up. Something is likely to change in the next 30 years, don't you think? There's some sort of risk to lending you $1 million for 30 years. So a yield curve should state that the risk to a bank, and therefore the percentage they charge to you, is low on the short term and goes up over time. So, for example, what color are we on? For example, 1 year should charge maybe 1%. Okay? 5 years should maybe charge, okay, right? 10 years should probably charge a little more. You see what I mean? A 30-year mortgage might cost you 4.5% right now. And that's actually about right, isn't it? So that's the basic premise of a yield curve. Okay? If you lend money, the longer you term the longer time frame you lend the money out, the more risk you're going to face. And then there's other things like time value of money and all this other stuff, but we don't need to complicate it. Okay? It's just it has to do with risk. And risk, in this case, is duration risk, which means time. The more time, the more risk, the more risk, the more you're going to have to charge for your loan. Okay? Okay. So let's talk about now. Let's go here and let's make this. Okay. Now we see something like well, and this. So, anyways, we see some. It looks more like actually. It looks more like this. Okay, and there's also a spread between the 2 and the 5 and the 2 and the 10, and it really has to do with the spread narrowing and dropping. But let's talk about this. This is closer to like what we have now. What does this mean? Well, a yield curve like this red one suggests that interest rates are pretty low on the short run, and they're extremely low in the long run. So somebody has driven rates down. And it doesn't make sense if you lend someone money for a year and charge them a 1%, to lend them money for 30 years and you only charge 1.5%. Doesn't quite make sense. So you have to ask yourself why. Okay? And somebody is buying the 30-year bond. Well, why did they do that? Well, at one point, it was paying 5% or 4.5%. And then something changed. And somebody started buying all these bonds, sometimes called debt. But they weren't buying this. Why? Well, if you invested in the 1 year, it didn't pay you any money. Hardly any money. If you invested into the 5 year, it only paid you 1.5% or 2%. Okay? Just a year and a half ago, if you bought the 10-year T-note, it paid 3%. Okay? And 4%, here. So people started locking in these high yields, and they started driving the yield down and down and down. So people were buying, or investors were investing in, to the long end of the yield curve. And as they bought, they drove the prices up of those assets, okay, and the yield came down. So let me talk about what predicts a recession. Okay? That predicts a recession. When people say, oh my God, the inverted yield curve, doom, doom, right? What does that mean? So let's talk about economics here. I often use the example of a shoe salesman, a shoe store. You're an entrepreneur and you own a shoe store and you have $5 million in inventory. You also have employees, you have rent, you have marketing expenses, right? And then some sort of owner's equity, and then of course some sort of distribution to investors, right? All right, so here's the cool thing. You work it out, and by the time you pay everything, you make 5% net operating income, which means revenue, rev, minus expenses is your essentially profit, net operating income, okay? But from that, net operating income does not include financing, does not include the financing charges. It includes rent and employee salaries and all that kind of stuff. but it doesn't include the cost of financing your $5 million in shoes. So this becomes critically important because every business on the planet, well, not every, but most, a typical business, they borrow money on the short run, on the short term. They buy some sort of inventory, or they make whatever product they make, okay? So you're either making the shoes or you're buying the shoes to sell. You see what I mean? Like if you're making the shoes, when do you get paid? When you sell the shoes to a wholesaler, okay? Like a shoe salesman. But you have to buy the leather in advance. You have to design the shoes in advance. So you have to have employees and computers, right, to design the shoes so that you can have an AutoCAD of it. So then once you have all that, then you need the leather, you need the rubber, you need the plastic, so on and so forth. And then you need the machines to be able to cut things out and put things together and the workforce. How many bajillions of dollars do you need before you even make a shoe? You understand? Like before you even make a shoe, we're like General Electric. They're like, hey man, we're going to build you a nuclear power plant. It's going to take 8 years to build, and we're going to charge you $3 billion. Well, what are they going to do? Work for 8 years before they collect an $8 billion check or $3 billion check? No, they get paid along the way. Well, in this case, if you make shoes, or in this case, you sell shoes, you don't get paid until after you've made the investment. So therefore, commercial banking comes into play. You call up your banker. So a buddy of mine, he's a banker. So you call up Johnny. You're like, hey, Johnny, I need 5M. And he's like, okay, I'll lend you the 5M. Great. Okay? Now you got to pay for that. So in a good world, if you're just borrowing for less than a year, you're paying 1%. So your net operating income minus your financing costs, and you're bringing home the bacon of 4% return on investment. Pretty cool, right? Everyone following me? Basic logic, intelligence, not voodoo magic. This is economics and business 101, right? But then what happens? Wow. People come in, they buy all your shoes. Fantastic. So you buy some more shoes, you put them out there, boom, 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 market gobbles them up. You buy some more shoes, put them out there, it's back to school, boom, 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 boom. They're just gobbling it up as fast as possible. Why? People have jobs. Kids go back to school every September, they need new shoes, right? They have jobs, they feel comfortable with their income, they may even have future expectations of more income. Maybe their house is going up in value, so we call this the wealth effect. They feel richer, even though, right? But they don't really get to eat the equity in their house. They might extract it. So now we need capital markets for that and debt markets and all that kind of stuff. But they might take $30,000 out of their house, and what do they go do with that? Make an addition to their house and hire a bunch of electricians and construction workers and plumbers and roofers and painters and drywallers. Or they go out and they buy a car. Think of all the people that get employed when all of this is happening. Right? It's not just the car people and the car salespeople, but it's the people that deliver the cars from the factory. It's the factory workers. It's the insurance salesman that insures the cars. There's so many people that get involved in the economy. And so therefore more jobs, and then wages start going up. And what happens when wages start going up and there's a bit of a shortage? You're selling shoes as fast as you can put them on the shelf. Why? Everyone has a job. So what happens next? The yield curve starts to shift. Why? Inflation. So the Fed comes in, or whatever, your central bank comes in, and they raise interest rates. And they're like, oh, so let's make this, I guess, black. Okay, so let's raise interest rates. They only care about the short term. In fact, central banks, they force the interest rate on the short term. they don't really do the long-term one. They can influence it, but they can't set it. They only set the Fed funds rate, which is the overnight rate. So anyways, the central bank raises interest rates because of inflation. Well, how does this affect your shoe company? You're like, oh, okay, well, you're selling shoes as fast as you possibly can. So you borrow some more money and you call up Johnny and he's like, yeah, well, it's 2% now. And you're like, okay, I'm totally cool with that. So now you're clearing 3%. Selling tons of shoes, you need to hire more employees, and they're like, yeah, you're going to have to pay me more money. I can get a better job somewhere else. And you're like, man, I need shoe people. So you start paying them more. And you see what I mean? And you're selling shoes and all that kind of stuff, and now it costs more to have them delivered from the factory, and all prices are going up, right? And people's rent is getting more expensive, and their insurance is getting more expensive, and the cost of food and the price of gasoline is going up. So now you have to pay employees more and all that kind of stuff. And the Fed comes in, they're like, uh-oh. So what do they do next? They raise interest rates. And they raise interest rates. And now your profit margin is down to 2. Time goes by, prices keep going up. You have to pay more for everything. Again, gas costs more. Cars cost more. Insurance comes more. Babysitters cost more. Daycare costs more. Healthcare costs more. Everything costs more. You have to pay your employees more. Everything's going up. So the Fed comes in, they raise interest rates again. Lots happening on the short end of the yield curve, not a lot happening here. So now let's get to the money shot. We talked about this one here. The short end at 5% and the invert, which means a 30 years actually 4%. This is the inverted yield curve. You may have read that we have inverted yield curves now, and somebody asked, does this mean we're going into recession? Well, let's talk about that. In this last case, the economy is booming. We have so much inflation that the Fed has raised interest rates to the point on the short term that borrowing costs are not only higher than long-term return on investments, but more importantly than that, that businesses, in this case, your shoe store, you're selling shoes as fast as you can put them on the shelf. But revenue minus expenses minus your financing cost, there's no economic or financial profit at all. And it can get to the point where you are now, so let's say you are only bringing in 4.5%, you're actually now losing money. Let's say you get to the point where you're selling shoes as fast as possible, but you are losing 1%. So let's talk about how this affects things. You're a publicly traded company, you some sort of, pay less than other stores type shoe store. And you come out and you're like, hey man, I'm CEO. I don't want anyone to worry, but we're selling shoes like crazy. Same store sales are way up. However, we're unprofitable. Ooh, what happens to that stock? Stock price takes a hit. Stock price takes a hit. 3 more months goes by. The Fed raises interest rates one more time to 5.25%. And you're losing even more money now. And you're CEO and you come out on the next quarter and you're like, yeah, third quarter was kind of bad too, man. We sold a lot of shoes. We're selling more shoes than we've ever sold in the history of our company, but we lost more money. What happens now when the stock market, because imagine this isn't just the shoe store. It's not like they're not running the shoe store very well. What's happened was their financing costs are higher than their profit margins. So it's going to happen to everybody. Everyone's definitely going to be less profitable than they used to be. Some people are actually losing money. So let me ask you this. Generally, the companies on the S&P 500 are reporting good business, but either much smaller profits or actually companies start losing money. What happens to the stock market in general when most of the companies are doing poorly or actually losing money? What happens to stock prices? Because remember, the stock market is the future value of current cash flows, of future profits. The current value of future profits. The current value of the expected future profits. Let me say that again. What is that called? The capital asset pricing model, CAPM, predicts that a stock price is worth the future value, the current value of all future profits. But the company is losing money, so the future profits are negative. So the stock price should be negative of what it was. The whole stock market comes crashing down because the stock market is predicting what's happening not today, 6 months and 12 months in advance. So if you start to see that most companies in the stock market are not doing well, in fact, you think in the next 6 months or 12 months they're going to lose money, you need to get out because the price of a stock is the value of all these future cash flows. So to be negative, that means you have a negative future value, right? So anyways, the stock market comes crashing down. So that's where now here I am to answer the question. You've been reading about inverted yield curves, and people are telling you that this means the stock market's going to fall and we're in recession. However, we're not in that scenario per se, are we? Did the Fed jack up interest rates higher than profit margins? Is it difficult to borrow money and make money as a business person? No, that is not where we are. It's not like that at all. This is different, okay? So now our yield curve looks realistically, you may have read an inverted yield curve, so therefore an inverted yield curve looks like this. Okay? So the question is, what does this mean? Is it the same as this? I'd say, okay, this one is inverted, but it's not this. So I don't know what our yield curve means because it really hasn't happened before. But do you think it's right? Okay, let me ask you this. Do you think it's right that the newspaper people and the TV people say, now I got to go to like a 9th color here. Is it correct to say that this yield curve is the same as this yield curve? Do you think that's correct? You think they're practically the same thing? They're both inverted, but do they mean the same thing? And now this is opinion, so I want you to think of it. I don't know, because the lower one hasn't really happened before. But do you think it's right to say they're the same, they mean the same thing, they have the same meaning? You should manage your entire net worth based on them having the same meaning. Okay? So just think of it. That's whatever you think. Okay? And then let me ask you this. Let me get some feedback here. Was this a helpful, useful explanation that you now understand? Okay. Right. Then thank you very much. Thank you very much. Right on, Adam. And Adam, you're right. The way I've explained it today is the falling, well, the market and, how do you say this in words? It was created by inflation, first of all. The Fed had to react to inflation. And its impact on business created the stock market recession and following economic recession, right? But does it predict it, or was it caused by something else? Is there a correlation or is there a causation? Did the inverted yield curve cause the stock market to go down? Or was it the inflation and the following Fed monetary policy? So, for example, if there's no inflation or very, very little inflation, if interest rates are low, so let's say a company goes out and borrows money for 2%. I bet you it's a lot less than that for inventory. It's actually less than that. It's probably 1%. So let's do it somewhat realistic. Oops. So you're a shoe salesman, or you own a shoe sales store. You go to the bank. Hey, Johnny, give me some money. I need to buy some inventory. Johnny says, okay, cool. It's 1%. The economy in the United States is doing very well, by the way. So you're selling shoes and you're hiring people and you're paying your rent and all that kind of stuff. Is your profit margin, revenue minus expenses, is your profit margin high enough? And by let's say, is it Apple? Is Apple making enough money? And then what about another non-tech company? I don't know, pick your company. Do companies on the S&P 500 right now have a profit margin higher or even significantly higher than their borrowing costs? Yes or no? What is your opinion? Or if you did some research, you should probably be asking yourself, what is the profit margin, revenue minus expenses, of whatever company you're looking at? And then what are their borrowing costs to stay in business? Even General Electric, used to be the biggest company in the world, has to borrow money to keep the lights on. Like every business on the planet borrows money. Every single one of them. Are their borrowing costs significantly less than their profit margins? Like, can they afford to be in business and turn a profit? The answer is yes. Then the inverted yield curve is practically meaningless. Because I don't care about the inverted yield curve. I care about the economy. Okay? So the yield curve has fallen partially because the Fed kept interest rates low too long. Maybe not too long, but they kept them low for a long time. So why would you invest in the 10-year T-note and earn 2% when you can buy a 20 or a 30-year and earn 3 or 4%, especially if inflation's only less than 2, right? So a lot of people just started buying the long end of the yield curve. But then the Fed has more recently come out to create this inverted yield curve. The Fed said, we're going to drive bond prices up. But we're not going to do it today. We're going to do it in 3 months and in 6 months. Let me ask you this. How many months, well, let me define it. Did the Fed tell us in advance, or at least educate and let the market believe the Fed was going to raise interest rates 3 or 6 months in advance? That's how a central bank works. They say, hey guys, we're going to drive bond prices up, but we're not going to do it for 3 months. So what starts to happen? People start buying bonds now. Why? Well, the Fed's going to drive the prices up. So whatever you buy today will go up in value in 3 months. Plus everyone else is doing it too, which gets asset prices already moving. So you're buying and everyone else is buying, that drives prices up. Then the Fed comes along, sure enough, they start putting money in the market and they drive the prices up. And when prices go up, yields fall. Okay? So the curve went from here to here, but it wasn't because the short end went up. You see what I mean? That's what we're really concerned about, isn't it? Isn't it? Isn't the point of an inverted yield curve is that the short end is so high that that you have to pay more to borrow money for three or 6 months than someone getting paid, than a bank lending someone money for 30 years, right? Like, isn't the short end being extremely high the problem, not the long end being extremely low? Like, does it really hurt you to borrow money for 30 years for cheap? So I want you to think about this in other ways. I want you to be intelligent about it. I want you to stop listening to what you see on TV or reading newspapers, because much of the time they don't even know what they're talking about. They just really don't. So I'd be more concerned about the Fed funds rate at 6% and a 30-year mortgage costing 4% than, the short end being 1% and the long end being, what was it? It was the 2-5 inverted, right? So what they were saying is it cost more money to, the 2-year was more expensive than the 5-year. So we know somewhere in there something weird's going on, but I don't know if that's enough to cause the entire stock market to crash. I don't know. That's up for you to figure out. That's up for me to figure out. But if you have an understanding, then you have the information you need to make an intelligent, informed decision. And that's all we're ever trying to do as professional investors and traders, right? Be able to understand the information at hand and how everything works together like Newtonian physics, gather the intelligence we need, and then formulate a strategy. And everyone else just runs around like a chicken with their head cut off. My head is falling, my head is falling. Forget about the sky, right? So there you go. That's me to you. Me to you, how to do yield curve analysis. Jeff, I don't think people do that anymore. I don't know anybody like that. So 10 years ago or 15 years ago, yeah, that was part of the problem. That doesn't happen anymore. There's just no way that happens anymore. But you're probably saying people are doing that now. I don't think that happens anymore, though. All right, well, thank you, my friends. Maybe leave a thumbs up or leave a comment and say, hey, man, that was helpful. I appreciate that. So There you go. 3, 2, 1, it's gone. Cool. So we're back to where we were yesterday. Ah! Are you a bull or a bear? That's it. One or the other. You pick. You choose. Doesn't even matter which one you choose. They just create obvious trade plans. So today at noon, we have our first swing trading group of the fall. And we're going to meet at noon. But I'll find out what time works better with the group. I'll ask and people kind of vote. And I'm also thinking about moving it to Thursdays, not Fridays. Right? Because what did I say yesterday on a Thursday? I was trying to teach you guys how to plan in advance. And I said, if you can't plan it on Thursday, then you don't have a plan, right? If you can't plan Monday on Thursday, you don't know what's happening. So we were here, and I'm like, yeah, it'll probably go up here and here and here if you were a bull. Or if you were a bear, it'll probably come around like this, right? So it's already done that. Like, it's set up already. It's almost like Friday's too late, bro. Like, you can't just be figuring this out now. Like, what's the likelihood, let's say this is yesterday, what's the likelihood you would have known that this would be a very obvious resistance zone? Like, duh, right? And now here's the interesting thing. We're getting into a buy zone. But this might be next week's sell zone. So, like, it's almost too late in many cases. Now, it's never really too late. Never tell yourself it's too late. Because if you're a bear, this is still very possible. Okay? And if you're a bull, this is still possible. Like, if you miss a trade, wait. I told you had to have patience and discipline. So there is no fear of missing out. Okay? If you were going to buy this and you didn't do it, well, don't do it now. Now you have to wait for something like this. And then buy here. You know, just you have to wait. You either get the pattern, you either buy at your price, or you don't buy at your price. You don't take. You're not a price taker, you're a price maker. Otherwise, you're a mofo, right? Pure mathematics. There's no FOMO unless you're a mofo. So anyways, so that's how that's going to go down today. Remember, if you're going to join the crew, we're starting today, just in a few hours. Swing.fxbootcamp.com. That looks right. Boom. So if you're going to join, join. The confirmation says 11? It said 11 on the confirmation email? Really? Ron says 11 a.m. Okay. Oh, because I said that because I wanted it to be on London close. Okay, well then 11 it is. Thank you. 11 a.m. Wow, I wrote a confirmation email, huh? Wow, it's cool, man. It's cool. So it's a new system, guys, as well. So let me just say this. There's a couple of things, obviously, I need to tweak and improve upon. But I'm tweaking and improving on it. So that's cool. We got time to get this right. Till the end of the year, Tova. At least. All I know is where we've been and what we've been through. Ooh. So anyways, cool, right? Cool beans. Anyone playing a triple top, or I should say quadruple top? Anyone going to go for it? 1, 2, 3, 4. Anybody's thinking about it? Remember, what we were talking about is the most ideal scenario is one like that, to be a bear. This is aggressive, and it's aggressive if you make money. If you lose money, you're a degenerate gambler. Sorry, that's that's the world. This is calm and cool, easy peasy lemon squeezy. Decent numbers out of Canada today? Sure, great. Does that impact the monthly R2? No, but if you sold there, you made money and the numbers came out and looked good, and you're like, yeah, boy. So remember, Jay Powell's flapping his gums today and is the big risk event for the rest of the month, really. And he may make or break your trade plan. So make sure you got your stops in all the right places. I got stops in all the right places. Taking my risk away. My trade's okay. All right. So anyways, look at that plan, huh? Very interesting. What do you think is going to happen when we get up into here? It's going to be interesting. Gregory, there's video courses. This is not a course. It's live trading. So that's why it's at swing.fxbootcamp.com, not fxbootcamp.com. So I'm just trying to find something sort of interesting going into this morning, but like I look at this, I don't want to talk about it. It's just not a good setup. Gold. Nothing really major here. You see how tight the pivot's got for next week. So it's sort of like a walk away. So the market looks like it's waiting for Jay Powell to do something. Now, in a scenario like this, like Jackson Hole in general never was intended to announce any new policy. Okay? And now the press is making a big stink about it, but, the press didn't even go 10 years ago. The market's fully priced in something that is not certain to happen. You understand, like, how one goof, one gaffe, one misinterpretation, one misstep, Powell says one thing, and then maybe a half an hour later, someone on the board of governors says something different. Anything like that. And the market freaks out. Because, really, the Fed says it's data dependent, right? When's the next Fed meeting? What is it, like 5 weeks from now? So what if Powell comes out and says, like, yeah, we're totally going to cut interest rates? Like, dude, I thought you were data dependent. Like, you're doing that before CPI and PPI and PCE and GDP and inflation and industrial production capacity utilization numbers. You're saying all of that before all of that information comes out, and yet you claim to be data dependent. Like, what are you talking about, right? I think there's going to be some sort of moment like that where he says one thing, someone else says something different, or he panics the market. Like, what did he say? The mid-cycle stuff. Remember that? I freaked out about the mid-cycle. I was on that faster than a lot of news outlets, right? And I was explaining what mid-cycle meant and what the interpretation was going to be. So what if he comes out and he's like, oh, no, I didn't mean mid-cycle like that. And I don't know, like, there's a lot of room for error. And my point is, not only is there a lot of room for error, for him to make an error, there's not much forgiveness in that error either. But for some reason, the market is fully loaded, like they've already cut interest rates 2 more times. So all he has to do is say one word or one phrase. Like last meeting, he said mid-cycle. And everyone's like, whoa, what? Did he just say something about mid-cycle? Like he had never said it before. And they're like, WTF? All of a sudden the markets go ballistic, right? And he didn't plan. I doubt he planned it and all this stuff. Like he just went off the cuff and said, it's a mid-cycle adjustment. Oh my God. What does that mean? Okay. So the market is fully loaded. The boat is already fully loaded, right? 2 price cuts already priced in, and all he has to do is say one word that doesn't even have to mean anything. It just has to be interpreted in such a way like, oh my God, there's not 2 hikes, there's only 1. He's not certain about December. He's not certain about September. That's it. That's it. He can say one word, and the house of cards falls. So that's why I decided to meet with the swing trading group today after that speech. So we might be able to get some aftermath, okay? But you can see the market is fairly quiet. You can see money moving to Switzerland here, okay? That's not good for macro. That's bad macro. Oil prices coming down. That's bad macro. Okay. So anyways, it's going to be interesting. And of course, everyone wants good macro. Well, Chuck Duck says he always does. Well, he's new, and every new central banker I've ever seen screws up in the beginning. So like Ben Bernanke, he's at his first dignitary meeting. I think it might have been Meet the Press dinner or something, and he's the brand new Fed chair. And there's a keynote speaker. He's not. This is before he gets up to do his keynote, but someone else is up on the podium speaking, and Ben Bernanke, he's eating his dinner and he's up at the big table and there's someone sitting next to him, and he leans over and says to somebody like, what a dumbass, something like that, right? Like makes a side comment about the guy speaking, like, what a dumbass. Turns out the woman he whispered that to just had to be like the head of the Associated Press, like the biggest reporter in America. And she's like, really? Boom, writes all about it. Like real big mistakes, right? Like it happens to everybody. It's just really funny. So here's what I suggest. We pulled the plug. We had a good yield curve discussion. And we can see most of these markets are just waiting to prepare for the big news. And then we'll pick this up like this afternoon, and then of course Monday, Tuesday, Wednesday, Thursday, Friday of next week. It's going to be exciting. So instead of just sitting here waiting for it, let's be productive and MoveOn.com. If you're going to join the swing trading group, we're going to meet in 3 hours. It starts in 3 hours. So swing.fxbootcamp.com. Other than that, thank you for being a subscriber to the Forex.Today YouTube channel. Thank you for being a client of Traders Way. If you have not done so yet, please visit tradersway.com, open up a demo account, and give them an opportunity to earn your loyalty and respect as a paying customer. So again, I will see you. Peace on earth. May the pips be with you. May your profits be above average. And feel free to watch the other 4,000 videos associated with my work on YouTube. You'll find it at Forex.Today, YouTube channel, Traders Way YouTube channel, and FX Bootcamp YouTube channel. Cheers. Forex for life. If you don't know the real value, don't join. You're not ready.